Howdy and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thanks for joining me. You know, the market's held flat Tuesday, but are down in early going as chip makers lead things lower, or so goes the headline. In reality, there's something else at work. The computers are at it again. That's what the networks can't be bothered to report because reality just isn't, frankly, as saucy as hype-driven headlines. Stocks like Nvidia, AMD, and other chip makers are widely held, highly liquid, and a source of tremendous options activity, which means they're being sold not because the big money fears bad results like you're being told, but because the big money wants to rebalance holdings and ditch leverage. Inclusion in scores of ETFs, funds, and the like amplifies the situation. Always remember, investing is about focus, not noise. So plan, execute, and repeat. That's simple. Here's my playbook. Number 1, how I see current market conditions. I was deeply honored to be invited back to the Cow Guy Close, an award-winning news program on RFD TV hosted by my longtime friend and colleague, the super savvy Scott Shellady, aka the Cow Guy, because of his colorful cow jackets. I think you'll find it valuable. Please watch it elsewhere on my channel. Number 2, if you're worried about Nvidia. All right, folks, it is time for some tough love. Nvidia just announced a $5.5 billion charge related to unsellable H20 processors and export commitments to China. Shares dropped overnight faster than a rookie trader in a zero DTE options pit and are still down this morning as I record this. But here's the deal. $5.5 billion sounds like a boatload of money, but it's just, emphasis on just, 4.21% of Nvidia's fiscal 2025 revenue. If that rattles you, you're not an investor, you're a speculator. And that's okay, but just do me a favor and do not confuse the two. Betting against Jensen Huang today would be like betting against Steve Jobs back in the day. I know what I'm going to be doing, and by the way, I hope you do too. And if you're an OBAer, by the way, keep an eye on your email for 2 high probability trade ideas later today if the volatility holds like I think it might. Keith's investing tip in this situation is very simple. Panic is not a strategy. Discipline is. Number 3 today, Lyft's big move and Tesla's bigger move. Lyft is acquiring FreeNow, a major European mobility app jointly owned by BMW and Mercedes for $199 million. Now, this marks Lyft's first international expansion, giving it access to over 150 cities across 9 countries, including Germany, the UK, and France. Now, this looks great and very exciting until you realize that Tesla has already got the vehicles on the road. Now, what's more, Tesla's FSD software improved and regulatory barriers fall, every existing Tesla out there becomes a potential revenue-generating asset ready to join a fully autonomous fleet at the flip of a switch or the push of a button. Now that's 0 to 1 thinking, not N plus 1. Lyft needs more drivers. Tesla needs an update. That's it. Contrary to what most investors think, scale isn't about size in a situation like this. It's about leverage. Tesla's got it. Lyft is chasing it. Keith's investing tip here. Understanding return to scale is key in a situation like this, and especially when it comes to investing in digital stocks. The more a company like Tesla scales with software, the lower the cost per unit and the greater the profit margins. A pair trade, by the way, could work very, very nicely, meaning you go simultaneously long Tesla and short Lyft. Number 4, surprise. The real opportunity in tariffs isn't new cars. Now, most investors are focused on tariffs, EVs, and how both are going to impact new car sales and incentives. But the real growth, I think it's going to be in the used car market, where prices will rise and inventory will dry up faster than a popsicle in Phoenix. Consumers are still under tremendous financial pressure. Financing is tough, and automakers have cut new vehicle production too far. The math says the demand for used vehicles will spike. Now, this is interesting because used car pricing is almost always that way, a classic case of supply and demand. And the imbalance, if you think about it, tends to favor sellers at the moment. Now, so I suggest you monitor companies like CarMax and AutoNation for sympathy plays. And this could be the break Carvana finally needs to make some decent coin. So, maybe there is a silver lining to all this tariff nonsense after all, anyway. Number 5, yet another reason to enjoy Google, or avoid Google. Enjoy Google. Avoid Google. Maybe that's a Freudian slip. I don't know. Anyway, Google's got more legal trouble than a bad poker player. 2 of the most recent headwinds of many that I have repeatedly warned you about over the years were coming. Number 1, Google is facing a £5 billion lawsuit in the UK for allegedly abusing its dominance in search advertising and to overcharge businesses. Like, that's a surprise. Not. And then finally, just yesterday, Japan's Fair Trade Commission issued a cease and desist order accusing Google of violating the country's anti-monopoly laws. People love Google, but I'm in the no thanks camp and have been for a long time, and happily, I might add. Google has seriously underperformed the rest of the Mag 7 over the past decade, and I'm glad I've avoided it. And the point here is that sometimes what you don't buy is often as important as what you do. In case in point, and just to really drive this point home, one of my favorite alternative investments, and I think still a super compelling investment choice, by the way, has returned investors 40x more than Google over the past decade. The investing tip here is real simple. Many investors doom themselves to poor performance because they fall in love with stocks they own, rather than staying focused on the long-term themes driving them. And that matters longer term because having even just a few shares of the right stocks on hand can result in life-changing wealth. Now, let me really drive this point home. A single share of my fave, for example, and in this instance, would have set you back roughly 53 cents on May 1, 2015, adjusted for splits and all that jazz. Earlier this morning, that same stock is worth $105.43, a 19,792% return, which means that every $1,000 invested back then would translate into $198,843 today. No doubt you see my point. People love to play the victim, thinking everybody but me is making money or that I can't do this. Yes, dang it, you can. And on a related note, if you'd like some help and confidence needed to set your own path, I'll be here and you know where to find me. Today's bottom line is very simple. Economists, clickbait artists, and the doom squad love to tell you about all the things that might go wrong. I often joke that they predicted 10 out of the last 2 actual downturns. But the world's best investors do things very differently. They're laser focused like we are on what's likely to go right. Remember, profits are always the currency of success. So on that note, and as always, make it a great day. You got this, I promise, and I will see you tomorrow. Thanks for watching.